Hope you're doing great. I wish everybody a happy new year. What you're about to hear for the next several minutes is my personal opinions and thoughts on where I see things headed in 2023. This should not be considered anything other than my personal view, of course, and it's not financial advice. 2022 was a year that the most would rather forget. On the equity side, it was the worst year dating back to the 2008 great financial crisis. S&P 500 lost about 20% this year. Tech-heavy Nasdaq actually had an even worse year, losing about a third of its value this year alone. Even the small cap Russell 2000 had a better year than the Nasdaq. Nasdaq stocks came under attack primarily from the rising rates. Some of the worst performing stocks in this index in 2022 were actually the former stars of 2020-2021. Tesla lost about 66% of its value in 2022. Nvidia shed half of its value. Some of the more exotic names, which were all-time favorites of retail investors in 2021, like AMC, lost 75%. The award for biggest losses, however, goes to the crypto stocks like Coinbase that lost about 85% of its value in 2022. Miners like Mara lost 90%. These stocks were hit by scandals, scams, and eroding confidence in the crypto coins. Amidst the sea of these losses, you will think you could have escaped them by diversifying into bonds. No, that was not the case. 2022 was also an exceptionally bad year for the bonds, and certainly very bad for the bonds and stocks when held together. Egged on by high inflation, which at its peak touched 9%, coupled with an extremely strong dollar, took the wind out of bonds. The 30-year Treasury bonds lost as much as 35% of their value, a drawdown not seen in decades. This was undoubtedly the worst year ever for stocks and bonds as far as I can remember. Amidst this carnage, did anything survive? Yes. Not only did it survive, it actually thrived. Driven by the geopolitics and war, the S&P 500 oil stocks and the energy stocks in general did very well. XOM rallied 80% on the year, almost doubled. Occidental Petroleum more than doubled. It is hard to believe that the oil itself was trading for less than $0 negative only a couple of years ago, as there was no way to take physical delivery of the contracts due to collapse in demand and saturation of storage. The crude itself was little changed this year. However, other energy products like the heating oil and natural gas as commodities had a bummer year. For those on the active trading side, the one theme that worked for most part of the year was that the stocks and the US dollar had a perfect inverse correlation. This in large part was due to the interest rate sensitivity of the stock market. And this is something I have not seen in years, mostly because the rates have been zero for almost a decade. This year was different. If you caught this early on in this year, and were able to recognize the havoc that the higher rates and as a result the higher US dollar will wreak on the growth darlings like Tesla at 400 or a Meta at 300, you stepped away from this incoming freight train in time and were not crushed. Will this trend continue now in 2023? While I think the US dollar will not go below 100, I think it will remain range bound, and I do not think that the US dollar will now make new highs in this year. This doesn't mean that the equities will continue to dance in tune with the US dollar. I don't think so. The correlation is not going to be there anymore. I expect this relationship to break at some point in the year, and I expect the equities could resume their downtrend due to a new, more negative theme, and that is the US recession. Now, the following factors will be, in my opinion, the key forces acting on the S&P 500 this year. Number one is the extent of the US recession. No recession, mild recession, severe recession. What is it going to be? Then the extent to the housing market downturn. I think some cities are much more vulnerable than others. For example, I continue to see weakness in San Francisco, Seattle, Austin, Portland, Phoenix, headed into 2023. Then there's China, the China reopening. This is good on many fronts, but the export demand will remain soft. And then the last one is the geopolitics and Ukraine-Russia war. End of war, continuation of war, or escalation of war. I'm not going into all the mechanisms of a recession and how it works its way into the S&P 500 pricing. However, let us look at another relevant metric, the Apple stock price. Apple stock is down about 25% on the years. PE ratio has also been hovering around 18, which is historically low, but not low enough. I became a bear on Apple personally at about $172 and remained bearish on it. And I could personally see it trade below $100 from last year or so. Now, the thing is, and everybody knows that, Apple is big. It is very big and constitutes about 7.5% of the S&P 500 index. It is even a bigger component of some other benchmarks. For instance, Warren Buffett's Berkshire Hathaway is made up of almost 40% Apple. Almost everyone who passively invests in the S&P 500, all your 401ks in the US stocks, somehow ends up as an owner of an Apple. Ends up as an owner of Apple stock. There's no way to escape it. When you look at it, you look at its price performance, it is down about 25%, but I think there is more room for downside. Look at one key metric for this stock, and that is the price to book ratio. This is extremely high in my view. I think it needs to come closer to its very long-term averages of about $10 to $15. It is at 40 now. I think this will deflate in the recession, and as a result, it will exert pressure on a lot of indices and ETFs that hold Apple as one of their main constituents. This is why I do think Apple could drop to below 100, and I think those will be attractive levels for me personally. I also shared a video on this 2-3 months ago, particularly on Apple, why I think it will go down. At that point, I think the stock was trading at 150 or so. It's much lower right now, and like I said, I believe it will go lower than this as well. On the S&P 500 side, on longer time frames, we are technically in a bear market in the S&P 500, Nasdaq, Dow, etc. The average bear market age tends to be about 10 months. The average declines can be 25 to 30%. Most, not all bear markets come with a recession. This one has avoided it yet, depending on how you measure the recession, of course. There is really nothing average about this bear market, as the macro factors are all so unique. I think this is the most unique macro year in almost 50 years. 2022, we shed 20% on the S&P 500. However, at the lows, we were down around 25%. Rising interest rates and stocks do not get along very well. This has been seen time and time again. There can be decades where the market goes nowhere because the rates were going up. Now, question is, will 2022 to 2030 be the decade that the S&P 500 goes nowhere? I don't know, but you can at least see all the ingredients are there if this turns out to be so. However, this is not to say there will not be a bull market somewhere. This is also not to say there are not potential opportunities on the bearish side. On the bull side, we saw the energy and healthcare stocks had a stellar year, rising anywhere from 20% to even 100% plus in some names like Oxy. This despite the slump in the growth names. However, you had to be on the right side of this and be macro aware. If you did not care for macro this year, you were crushed. On the bearish side, there were also so many opportunities to trend following the following names down, like Netflix or Meta or crypto, Tesla, Disney, PayPal, just to name a few, which had a pretty severe downtrend. You did not need a lot of fancy analysis to recognize this downside momentum. Longer term, there are a couple of factors which are important to me. Number one is, while there is still a lot of talk about recession and housing crash, on ground we're not seeing this play out yet. So I think market as a whole is not focused on this aspect, even though Twitter macro warrior is quite worried about it. And then while Federal Reserve has been super hawkish last few months, US dollar has not really believed them. It has remained low. When you look at these two factors, there is not a whole lot of catalyst at the moment for this market to sell off at the moment. Market says, well, there is no recession as far as I can see, and then the market figures the dollar is in no hurry to make a new high. Thus, it remains range bound, eating up all the juicy put premiums. If you are bearish here at these 3750, 3800 levels, these factors are not helping you. This is why I am not very bearish here near these lows around 3750, 3800, unless we actually break them and the dollar spikes, because who knows when recession will come, right? If this happens, this support will become resistance. This means I'm reacting if that happens rather than predict something which has not happened in almost 15 days now. This is why I think the longer term sellers may at least want to wait for higher, more favorable levels like 4050 or 4100 to re-emerge. Now, based on my research, 30% is a respectable drawdown in S&P 500 for your garden variety recession, which is about 3200, 3300 on the S&P 500. 50 to 55% can be seen in the more severe cases. For instance, we saw that in 2008 global financial crisis. Before that, we saw something like that only in the 1970s, I think. So these types of drawdowns are rare. So which one will it be, 30% or the 50%? Which one? I think it will be neither. I think since we have emerged from the pandemic recently, the stimulus money memory is fresh, as well as combined with some other factors like the China reopening and Ukraine-Russia war, which tends to be bullish for the equities. My worst case low in the S&P 500 for 2023 will therefore be 3,300 to 3,400. I think this level, if visited, could be a meaningful multi-month low for the S&P 500. Maybe it could be the low even for the entire year. We could see further downside action below 3,300 into 2,900, but I personally don't think it will be in 2023. On the upside, I think it comes down to two things. One is the current risk-free yield is around 4%. This may slightly go up as well in near month. This keeps a lot of money on the sidelines and could bracket the upside at around 4,300, 4,400 this year. Now, can we make new highs? When the saving yields are alone are 5%, anything is possible in the market, but I will be quite surprised if I see that. Now, if the unemployment ticks up and the recession looming with 1 year away from the elections again, I think the stimulus instinct of our politicians will kick in, especially with the way the Congress is right now. Old habits die hard, and the politicians are always short-sighted. This, I think, keeps a floor on the S&P 500 near the levels I described above. For the more severe downside targets into the 2000s, which again, I'm not saying cannot happen, I'm just saying it will be hard this year with the macro and geopolitics all around at the moment. If you are in the camp that the market will trade sub 3,000 this year, you have to ask yourself, is the dollar ready to trade 115, 120 and higher? Is the Fed ready to raise the rates to match or exceed inflation rate at 7 or 8%? No, I don't think so. I don't see that happen. For me, the equation is like, if inflation rate is higher than Federal Reserve funds rate, then that means loose financial conditions and inflationary environment for stocks. And if the opposite is true, and inflation is less than the Fed funds rate, then that only means a tight financial condition. Now, obviously, this may not make any sense right now if you look at it from all the negativity around us. But to help understand this, I look at the S&P 500 components. S&P 500 has 11 sectors, with tech as the largest component by market cap. It is about 25% of the entire market. Energy was the smallest sector up until last year at 2.8%, but since then it has expanded to about 5%. Not all of these will go to the doghouse even if the rates stay persistent. I think, in fact, some of these will expand to offset the shrinking of the IT sector. Remember, I'm a thematic investor, and my models are based on some key macro assumptions, which I have listed below. I will basically change my mind when my model changes. If not, I will not change my mind. And here are my assumptions. The inflation has peaked in my opinion. The inflation has peaked, although it may stay high in 2023 for an average of about 5%. The dollar has peaked, though it may remain range-bound in 2023. China will reopen rapidly. Ukraine war may drag on. The rates have peaked, but they may remain around 5% for 2023. Oil could remain supported at 70 to 95 range. If all of these assumptions are correct, then I think the following areas may benefit from this: healthcare, financials, and energy. Within this context, so what are some of the names that may remain supported or even expand in 2023? And the big banks may play a role if the S&P 500 were to find support near 3,300, 3,400 level that I mentioned. They've had a bad year, but better than the general market. Higher rates like 4 or 5% are good for the banks and insurers as long as the economy does not crash. 4 to 5%, while high now, is historically a normal range of rates. I like both JP Morgan and Bank of America in big finances, but Bank of America has sold off more than the Chase and could therefore be of a better value, in my opinion. Again, with rates staying high through 2023, with the US avoiding major recession, this could be a plus for the banks. Basically, they will have low loan losses. Defense is another area that would possibly benefit from this environment. And you may the healthcare, of course, and energy are the other potential winners from this. I'm not going into details of those, but I just wanted to generally mention what I think what sectors would win. And you may ask, what's going to happen to tech? I think there is some more fluff in the tech, and I do think tech will come down on balance. For example, see my post about Apple from a few months ago. Also, the earlier part of this video kind of covered that. You have to ask yourself, what can cause a tech to rally here? If inflation were to drop below 5% this year, that will void my models, and I think will be good for techs. Every call that I make is based on these models, and inflation remaining above 5% is the backbone of my model for 2023. This means I expect to see a sub $100 in Apple. This means I could expect an Amazon trading at $70. On a side note, and I will make a video on this, in these environments, it sometimes makes sense, especially since the stocks are at longer time lows, to benefit from some dividend plays. I will probably make another video just to focus and talk about the names that I think might be good plays for this year. But just to mention one right now, I think Intel Intel is at really good levels right now, about 25. Is pretty undervalued, and I think it has, if I'm not wrong, about 5% or so of dividend yields. That's it for me for now. Thank you for listening. Have a great rest of the day.